Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look at is Spirax Sarco Engineering Plc stock a buy right now? What is Spirax Sarco Engineering? Ticker symbol SPX. It is a company that provides industrial and commercial STEM systems, electrical thermal energy solutions, and niche peristaltic pumps and associated fluid path technologies. The firm is focused on three specialist engineering businesses, including STEM specialities, electric thermal solutions, and Watson-Marlow. The firm serves industries including pharmaceutical and biotechnology, food and beverage, original equipment manufacturer, oil and gas, chemical, power generation, healthcare, buildings, mining, and precious metal processing, water and wastewater, pulp and paper. Lots of different industries that they are involved in. Some key stats for SPX are that they are based in the United Kingdom. They work in the machinery industry. They have a market cap of 5.4 billion. They went public back in 1986, have over 8,000 employees, have a dividend growth streak of 7 years with a 5-year dividend growth rate at over 11% and a dividend yield at 2.21%. Over the last year, the stock has performed very badly, being down 24.71%, as we can see on the graph. And what we're going to have a look at today is this stock a buy right now? So if we dive a little bit deeper into their earnings call and fundamental analysis, Spirax Sarco Engineering has 37 strategically located manufacturing plants across the world and are committed to creating a safe and inclusive working culture for their workers while operating in 66 countries and serving 110,000 customers globally. Their adjusted cash conversions in the first half of the year was in line with their expectations at 53%, as they were targeting for 48% or higher. The board has declared an interim dividend of 47.5 pence per share, which is a 3% increase, reflecting their confidence in a return to higher levels of growth and margin. The dividend will be paid on the 15th of November 2024 to shareholders on the register at the close of business on 18th of October 2024. SPX expects mid to single digit organic revenue growth for the full year and are expecting their adjusted operating profit margin to be broadly in line with the 2023 margin, adjusted for currency headwinds of 20%. They also anticipate full year adjusted cash conversion will be higher than in 2023 at approximately 75%. Some key fundamental analysis for Spirax Sarco Engineering is that it has a positive free cash flow at 200 million, positive net income at 183 million, positive operating income at 312 million, positive gross profit at 1.3 billion. They have a positive ROE at 16%. Very solid long and short-term solvency. They have a low debt to equity score at 0.96, have a high Altman Z score at 4.73. They have an average interest coverage at 6.35, and they do have positive net debt at 745.3 million. From this, we're then going to have a look into the free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading. If they have a free cash flow that is deteriorating every year and getting close to into the negative numbers, they are going to very much struggle to keep increasing that dividend payment and do share buybacks and actually invest back into the company. So that's why it's very important that your company that you're buying into has healthy free cash flow. We can see from the graph that SPX has been steadily increasing its free cash flow since 2013. Interestingly, throughout the pandemic, they were not massively affected and managed to continue growing their free cash flow, but they did have a slight dip in free cash flow towards the back end of 2022 and going into 2023. This was mainly due to the lower demand from customers in the biopharm and semiconductor sectors, which impacted their highest margin business. Since then, they have managed to grow their free cash flow to back over 200 million and are close to all-time highs, which was back in 2021. On top of this, they have a very healthy free cash flow payout ratio at only 63%, so that's around the number that you'd like to see for a company like this, and it does mean they have scope to continue increasing that dividend payment. We're next going to have a look at the discounted cash flow valuation for Spirax Engineering. The DCF method is an estimating of the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on a selected operating model. A reminder that their current price is 7,310 GBX. When plugging in a discounted rate at 8.2% and a terminal growth rate at negative 2.7%, we can see that SPX was valued at being only 3,324 GBX, which would be a massive overvaluation at 55%. Their base case scenario, with a discounted rate of 8% and a terminal growth rate at 0%, would be worth 5,545 GBX, which is an overvaluation of 24. And in the best case scenario, with a discounted rate at 7.6% and a terminal growth rate at plus 2.7%, they would be worth 10,941 GBX, which is an undervaluation at 33%. Spirax Engineering relative valuation. So by looking into the DCF model and also the relative valuation, we can then come up with something called the intrinsic value. This is a method that's been used for many, many years by many different investors to value companies. So by getting the relative valuation, it means we can then add the two together, divide by 2, and get the average for them. Relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics that I like to use are EV to revenue, EV to EBITDA, and PE ratios, but there are many other metrics that you can interchange in and out. On the worst case scenario, when using my numbers, we can see that SPX was valued at 9,382, which is an undervaluation of 22%. On the base case scenario, they were valued at 10,488 GBX. And on the best case scenario, they were valued at 11,825 GBX, which was an undervaluation of 38%. Like I just mentioned, we can then get the intrinsic value by adding these two together and then dividing by 2. So at their current price, it's £73.10. On their worst case scenario, they were worth £63.53. Average case scenario being worth £80.16. And their best case scenario being worth £113.83. I not only just use these two metrics to determine if I'm going to buy a stock, I then get a third valuation method, which is the Wall Street estimates. The Wall Street estimates are an average estimation of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. For companies the size of SPX, you're going to have multiple analysts looking through the company on a daily basis and trying to come up with the most accurate as possible determination on their 1-year price targets. The worst case scenario, Wall Street estimates believe that they are going to be worth 8,080 GBX, which would be an 11% upside. On the average case scenario, they believed it would be worth 9,855 GBX, which would be a 35% upside. And on the best case scenario, they believed it would be worth 12,600 GBX, which would be a 72% upside. Their current price, as just mentioned, is £73.10. So now that we have all three valuations, I can combine the three valuations and get my worst, average and best case scenarios for Spirax Sarco Engineering. On the worst case scenario, we can see they would be valued at £69.29. So if I was to use a 10% margin of safety on this price, I'd be looking to buy the stock at around £62.36. And with a 20% margin of safety on the worst case price, I'd be looking to buy at £55.43. On the average case price, we can see that it is valued at £86.30. So with a 10% margin of safety, we'd be looking to buy at £77.67. And with a 20% margin of safety, we'd be looking to buy at £69.04. And then their best case price was £117.88. So with a 10% margin of safety on this price, we'd be looking to buy at £106.09. And with a 20% margin of safety, we'd be looking to buy at £94.30. So what does this mean for Spirax Sarco Engineering? Is it a buy right now? I think that right now, Spirax Engineering Group are at a very attractive price. They're at a 52-week low due to some short-term turbulence in certain areas of the business, but other areas are still excelling. And taking a step back and looking at the bigger picture, they are still showing promising signs long-term. It's a very well-established business that has a track record of not only paying and growing their current dividend, but also having a very healthy FCF ratio that we showed earlier, and are actually growing year on year. Their high dividend growth rate over 11% over the last 5 years also leads to a stronger case for potentially owning this stock in your portfolio if you are a long-term growth-focused dividend investor. By looking at our valuation methods in the last slide, we can see that if using around a 10 to 15% margin of safety on the average case price, Spirax Group would be a buy right now. And is it a stock that you're then thinking of adding to your portfolio? You'll have to let me know in the comment section down below. Personally, although it's at a 52-week low, I would potentially want to see this around the 20% margin of safety for it to potentially be considered as a buy right now. But what do you think and what are your thoughts on this current business? I hope you enjoyed today's video. Please let me know of any other stocks you want to see a full breakdown on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.